Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back. Today we're going to talk about how best to load up the truck with shares when you've found an investment that you want to buy. So the overall goal for me personally when I'm investing is to buy something at a significant discount to what I believe that shares or that company to be worth. So I've spoke about it plenty of times already, but essentially I want to buy $1 of value for a price of 50 cents. And often this is going to be driven by some sort of short-term fear in the market, either in the overall market or around some individual company that I'm looking at. So that's my basic strategy. I want to buy $1 for 50 cents. It's the same strategy of Warren Buffett and a whole bunch of different value investors out there. And I want to talk you through kind of once you've identified one of those potential investments, how you actually go about loading up the truck with as many shares as you possibly can at the lowest possible price. Because essentially the overarching goal when you make any investment is to make a significant difference in your net worth, and to do that in a value investing kind of strategy, you want to own as many shares as you possibly can at the lowest possible price. So let's talk through how you do that. So what we're going to talk about today is something that's often referred to as averaging down or reducing basis. It's something that Phil Town in his book Payback Time, this one here, Phil Town in his book Payback Time, calls stockpiling. So essentially stockpiling is all about taking advantage of falling stock prices. So if you make an investment and you think that's worth $1, has a value of $1, and you can buy it for 50 cents, if that price actually happens to fall down further to say 40 cents or 30 cents, stockpiling basically means that you go ahead and just keep on buying shares. The lower that price goes, the bigger the margin of safety that you're getting, and the greater the returns that you can generate as well. So I want to preface this by saying there's really no exact science to what kind of proportion of that investment you should buy up front versus what you should wait for the stock price to continue to fall for, and that kind of thing. But I'll run you through some general guidelines from Phil Town and some guidelines that I tend to use as well. So the first thing I'm going to do is when I'm looking at an investment, I want to figure out how much money in total I want to put into that company. So in today's example, just to make the figures nice and easy, let's say that's $5,000 that I want to put into one company that I've identified and that I've found is on sale at well below what I believe that company to be worth. So what I'm first going to do, and again, no exact science to this, but I'll show you an example of how this can be a really powerful strategy. In example one, I'm going to put all $5,000 into that company in one hit at a price of, let's say, $10 per share. So I believe the value is more like 20, but the price is $10 a share. So what that's going to leave me with is 500 shares in that company, maybe slightly less after taking off some commissions for brokerage fees and that kind of thing. But that's going to leave me with with 500 shares at $10 a share. And if I'm correct in my assessment, and that does eventually rise to $20 a share to its intrinsic value and what I believe it to be worth, that investment is going to also double, and that's going to leave me with a total value of those shares of $10,000. So that's kind of the strategy that I used when I was initially starting out investing, was to kind of just buy everything in one hit. Largely because I was working with very small amounts of money, and in the grand scheme of things I still am, but that's kind of the initial strategy. The next strategy I want to talk you through is what happens if you actually reduce your basis as that stock price continues to fall. What are the risks associated with that, and kind of some situations where you might not want to take that approach as well. So what I've got up on the board here now is an example of the same investment but with a stockpiling approach. So what I've done is, again, no hard and fast rules on this, but instead of investing all $5,000 in one hit at a price of 10. I've invested $1,000 at a price of 10. I've invested a further $1,000 at a price of 9. Same again at a price of 8, price of 7, and a price of 6. So I'll talk through how realistic maybe this is in real life shortly, and some risks of this. But essentially, assuming that the price continues to go down, but the value of the company remains the same, I really can't emphasize that enough. If the value of the company is also falling, this is not an approach you want to take. This is only in situations where there's a short-term price fall and the overall kind of value of the company is unchanged. There hasn't been a significant change in how much it's going to grow in the long term and those sorts of things. There's a short-term price fluctuations because of maybe a recession or some type of short-term issue that the company's having. Can't stress that enough. But anyway, if I go ahead and invest $1,000 at each of these levels, I've still invested $5,000 in total. But in the first example, I was able to purchase around 500 shares, or exactly 500 shares. What I've ended up with now is at the first purchase, I get 100 shares. The second, I get 111. The third, I get 125. The next one, I get 143. And the next one, I get 167. And in total, I actually end up with 646 shares. Almost 150 more shares than I ended up with the first time by just investing everything in one go. So the real advantage of this is taking advantage of that one company you've found, because great opportunities like this don't come up often. Great companies to purchase are well below their value. They're rare, they're hard to find, and we want to take as much advantage of them as we can. And this is going to enhance our compounded rate of return if we can do this successfully. So that's given us 646 shares. What that actually becomes when this company returns to intrinsic value, or returns to what we think it's actually worth. In the first example, our $5,000 turned into $10,000. Brilliant, well done. In the second example, this is actually turned into $12,920. So we've made almost an extra $3,000, an extra 30% on top of what we initially invested. And in terms of a return on our initial $5,000, we've actually made an extra 58% return on that initial money. So we've made an extra sort of $300 out of, $3,000 out of the $5,000 that we initially invested. So we're up about 200% in this one versus 258% in this one. So it can be a really, really powerful tool, and essentially the further that price comes down, assuming that the underlying value of the company has remained unchanged, the more money you can potentially make. A very powerful tool. The maths is pretty straightforward, but when you go out and take some real life dollar examples, this can do some really cool things. So I want to take a couple of minutes to just talk about some of the risks of this, some of the potential downsides and things you want to watch out for, and maybe some reasons why you also wouldn't want to take this approach as well. So hang around for the next few minutes. So the main risk of using a strategy like stockpiling is pretty simple. It's that you make your first initial investment. In this example, that was our first $1,000 at $10 per share. And the main risk of what happens next is basically that the price goes up. And we no longer are able to stockpile into that investment and get as much money as we wanted to into that company. It's not much more complicated than that. That is a genuine risk. If you're investing in the stock market for a long time, it's highly likely that this company is going to drop back down again at some point, but that is a risk. So it's something to watch out for. There's no strategy like this where you want to enhance returns where there's not at least a little bit of risk of it not working out perfectly. So that's the main risk. Essentially the price goes up. So if the price goes up, we do well because we've invested money and we've benefited from that appreciating share price. So if it goes up, we do well. If it goes down, we get very rich. So, it's good either way, but it is a risk that you're not going to be able to build a significant position in that company if the price instantly goes up straight after you purchase it. So that's a risk. A couple of situations where you might not want to take a stockpiling approach. There's really only a couple that I can think of where you wouldn't want to take this approach. The first one is that the company value drops. So I mentioned this a couple of times already, but if something fundamentally changes about the company, that's not a reason, or that's a reason that you don't want to stockpile into this any longer. So if it's worth $10 and you think it continues to be worth $10 and the price goes down, that's fantastic in terms of stockpiling. If the value is $10 and then something fundamentally changes at the company, their growth slows down and it's expected to do that for a long time, for example, that means the value is also falling. The key sort of underlying principle to having stockpiling work well is that the value remains unchanged and you can continue to buy at a larger and larger discount and margin of safety to that value. But if value is also coming down, that's not a good thing, and that is not a situation where you want to take a stockpiling approach. So that's reason number one. Reason number two, when you might want to avoid doing this strategy, is actually to do with commissions. So by commissions, if you're not familiar with this, basically every time you make an investment through your broker, you're likely to have to pay a fee, unless you use some sort of online discount broker like Robinhood or something like that. You're likely to have to pay a commission. So typically they're not huge dollar amounts, but sometimes if you're trading internationally, for example, those prices can be a little bit higher in terms of commissions. And if you're investing really small amounts of money, sometimes that can actually be quite a big percentage of your investment. So as an example, typically what I would say is to kind of limit the commission, if possible, to about 1% of your investment. So if you invest $1,000, don't let that commission be more than about $10, as an example. If you go into something and stockpile and you wait for the price to dip, say 5%, but you're also paying a 5% commission on that money because you've divvied it up into such small kind of sections, there's actually no advantage to you waiting for that to happen. Arguably, you get a larger margin of safety, but in terms of the actual amount of money you can funnel in, there's not a huge advantage to that at all. So commissions are the main one to watch out for. This is really likely to affect you if you're working with very, very small amounts of money or if you're using quite an expensive broker. So one to watch out for. But outside of that, there's a lot of advantages to stockpiling, a lot of advantages to pulling down your average price. But these are a couple of things to watch out for. So I hope you've enjoyed the video. If you did, drop me a like and subscribe. Give me a comment, love to hear your thoughts as well. Is this an approach you're familiar with? Is it something that you've done before? If not, why not? Do you have any other points that I should be putting up here around why you wouldn't do this? Personally, I think it's a great opportunity to maximize any potential investments that you find and really crank up your returns. So hope you enjoyed the video, and I hope to see you in the next one. Cheers.